Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And today I want to talk about the topic, how do you determine whether it's worthwhile paying for financial advice? Because it's a question I actually get quite often. And, it really does depend on a few key factors like, how much surplus investable cash flow you have, the size of any existing investments in terms of the value of existing investments and those sorts of things. But at the end of the day, if you're going to engage a financial advisor, there's obviously a cost, an investment to do that. And you want to make sure that if you pay out these fees over the next 10 years, that you're going to be substantially better off. So that is that the value that the advisor can create working together over the next 10 years is going to be substantially more, maybe, 10 times more than the fees that you pay them over the next 10 years. If you can become confident that that's going to be the case, of course, then it makes sense to go and get financial advice. But what are some of the factors that you need to think about to be able to contemplate, the cost benefit analysis of undertaking that? And that's what I want to talk about in today's episode. Of course, there could be a number of factors that you need to think about or that could warrant getting advice worthwhile in your situation. But let me talk about the two most common sort of factors that we consider or come across. And again, these two aren't an exhaustive list, but they're the most common. The first one is, how much money do you have to invest? The potential benefits of getting financial advice obviously increase with the amount that you have to invest. If you're investing a lot of money, the long-term outcome of how well you do could be considerable. So for example, if you're only investing, say, $2,000 a year, and you do that for the next 20 years, if you earn an 8% return, your investments are going to be worth $61,500 in today's dollars. If you get a 10% return and do better, well, your $61,000 becomes $78,000 in today's dollars, so an extra $16,000. Now, that's a reasonable difference, but if it's going to cost you more than $16,000 to get advice over the next 20 years, and it almost certainly will, then it's not really worth the expense. On the other hand, if you invest, say, $60,000 a year for the next 20 years, which most people listening to this podcast will probably do if they include superannuation contributions as well, then even a 1% difference in annual returns can lead to an additional $200,000 in today's dollars. And so if you're going to pay, say, $50,000 for advice over the next, or $100,000, whatever it might be, for advice over the next 20 years, then you're still in front. It's not hugely compelling. It's still pretty good, of course. But, my point is the more you invest, the better the outcome. And so to extrapolate this even further, if you're investing $150,000 a year, which might be super contributions plus a large investable surplus cash flow, then even a 0.5% difference in performance over 20 years is $250,000. And so that's the point, is kind of how much do you have to invest? Because if you're going to, if you've only got a $2,000 surplus, you're probably going to pay that all out in fees, right? And then you've got nothing to invest. So it's really, what is the long-term performance that you might achieve, and how sensitive is that performance to the investment returns? And then how much is your surplus investable cash flow versus the fees that you might otherwise pay? So again, if your surplus cash flow is $5,000 a year and you've got to pay $5,000 a year for advice, then of course don't go and pay for advice, because that eliminates all your surplus cash flow. But surplus investable cash flow is only one element, right? That's only deals with, investing new money. And of course, a financial advisor can help you with that. But there could be lots of other things in addition to investing new money that an advisor could help you with. So of course, developing a strategic long-term investment plan that sort of sets out how you're going to actually fund retirement and what steps you need to take over the next 10 or 20 years or whatever it might be in order to get into that position where you're going to be in a very comfortable financial position to have a comfortable retirement. Making property related decisions, whether that's, around your home, whether to upgrade, downgrade, do all those sorts of things or invest in property. But there's a lot of property based decisions that can have impact on financial plans. One of my future podcast topics, in fact, is going to be about talking about those. Of course, reviewing, managing, optimizing existing investments, including property investments, mitigating risk, personal insurance like life and TPD, and ensuring your estate plan is is up to date, collaborating with your other advisors like mortgage brokers and accountants to identify new opportunities. There's lots of things that a financial advisor can help you with that are going to add value or potentially add value, depending on your circumstances, over the next 10 or 20 years. And of course, navigating the inevitable changes in life. If there's one thing that is constant, it's change. And some of those changes necessitate us to really sit back and think, okay, and ask ourselves, what impact does this have, if any, on our long-term financial strategy? Now, of course, it probably goes without saying, the more scope there is for an advisor to help you with these things, the more potential value there could be in working with an advisor. So let me put this a different way. If all you want is advice on how to invest a certain amount each month, that scope's very narrow, and it's then going to only depend on how much you have to invest in that particular month or on a monthly basis. If investing, regularly is only one of maybe 10 things that an advisor can help you with, well, then the amount that you're investing is less important, still important, but less so, and that might warrant then, greater scope to sort of add value. So they're the kind of approach, they're the two things you want to start really thinking about: scope and investable surplus cash flow. And then, of course, the next step is then how do you assess the potential value of advice? Now, it feels really natural to think, okay, it's all just about investment returns. And really that's what an advisor should do, is just maximize investment returns. But I really think a better way to think about advice and the benefit of advice is really about achieving your lifestyle goals. So for example, if I can help a client over the next 20 years to get into a position where they're going to have a really comfortable retirement and never have to worry about money, then I consider my job is done. And in some cases, to achieve that goal, I might be taking lower risk, which means I'm achieving lower returns. Taking higher risk in every situation can be counterproductive. So I really think it's really about goals. Now, of course, investment returns are important. If you're losing money, you're not going to achieve your financial or lifestyle goals. Of course, that makes sense, right? But also, no one can control markets. No one can control returns. We can worry about the factors that we can control, like, how and where you invest, the fees that you pay, the tax implications, the cash flow. But ultimately, the returns are going to be relatively unpredictable over the short term. More predictable, I think, over longer periods of time, say decade periods of time. But I just think I'd balance out or caution people when assessing the value of advice. You've got to kind of not just be too focused on returns, because that might not tell you the full picture. And I know there's some clients that I've worked with that, that aren't maximizing returns, and that's completely fine for them and their situation. So I hope that kind of makes sense. I've explained that well enough. So how do you go about quantifying the value of advice? Well, and I've got a link to this report on the blog on the website, but Russell Investments, which is a global fund manager, produces a white paper each year where they try to quantify the value of advice. And its latest report, which is dated 2023, estimated that advice can save you or make you 1.2% per annum with asset allocation decisions, 3.4% per annum with behavioural coaching, and an additional 1.3% through tax optimisation. So they think, or they've arrived at, the value of advice is worth 5.9% per annum in terms of a return on that investment. Now, it's noteworthy to highlight that none of the advisors in my office agree with these figures, and we suspect they're overstated. Now, you've got to realise that, Russell Investments, they're a fund manager, they're trying to produce information that's going to help advisors speak to their clients. But of course, the value is going to really depend on each individual. And really the analysis you need to consider is what performance or what potential outcomes could you achieve by working with an advisor, and how well could have you done without the advisor, right? And that's going to be different for everyone, because some people are going to be, more interested, more driven, have a natural talent for investing, these sorts of things. Other people, they're going to be completely stuck. They would struggle without any advice. And in that case, the outcome without advice is really poor, and the outcome with advice hopefully is much, much better than that. And so for them as an individual, it's worth a lot more than, say, someone that is quite a natural talent for investing and has a flair for it and will do pretty well on their own. for instance. And so we think it's more useful to I think it's more useful to sort of outline the factors to consider and ultimately let you as the individual, you've got to come to your own conclusions. All I can do is sort of point to the things, here are the things that you need to think about, but unfortunately I can't give you a spreadsheet or give you a particular number to work off to say, okay, well, if you can tick these boxes, getting advice is definitely going to be in your interest. So then let's talk about those things. I've sort of split them up into 4 areas, if you like. So the first one is I've described it as how, where, and when to invest new capital. So I guess this is one of the more obvious benefits of working with a professional financial advisor, is that if you have new money to invest, they're going to help you decide where and how to invest that. And I think there's 2 key elements that an advisor brings. The first one is knowledge, and the second one is experience. A good advisor will spend a significant amount of time each week researching, analysing, and thinking about investment related matters. However, it's the experience that helps them work out when and how to effectively apply that knowledge in different markets and in different conditions. And so knowledge without experience, I think, is not worthless, but risky. And I think that the more experience that someone has, together with a good, robust amount of knowledge, reduces investment risk. So investment advice can really add value, I think, in 4 ways. The first one is investment approach. So a good advisor should have a well-considered, time-tested investment approach. So my approach, as you're aware by now, if you've listened to any of these podcast episodes, it's very much based on an evidence-based approach that maximizes success, whether that's to invest in property and understanding, that an evidence-based approach with property works, or it's investing in shares, which is kind of a low-cost, rules-based index sort of approach. Either way, the investment approach should add value in terms of helping you construct a portfolio. The next element there is then asset allocation, because we've got complete control over where we invest our money. What we can't control is subsequent returns, particularly over the short term, but where we invest our money, we certainly can control. So asset allocation can be as broad as, how much to put in the property market versus the share market. And hopefully you want to work with an advisor that, that has equal understanding and experience in both of those 2 key growth asset classes, being both property and shares. And it might be that in your circumstance, you should be all shares or all property. I don't know. But, you just want to make sure, if I'm going to determine it should be all shares, that, I've got still a good understanding of property in order to arrive at that conclusion. And then the other asset allocation things, particularly with shares, it's going to be, what index strategies to use for what geographical markets, how to build and construct a portfolio, when to rebalance if that's ever necessary. With property, it's really which geographical markets, property types are we going to invest in, and then, of course, which buyers agents are we going to trust in order to select those assets. The next factor with respect to investing new monies is optimizing taxation outcomes. So that involves understanding the tax characteristics of a particular investment, making sure that we're choosing the right ownership structures, minimizing turnover, understanding different tax implications of different investments. All we're trying to do is maximize after-tax returns. And one way we can do that, of course, then is minimize tax. And the final element to it is fees. Investment fees are certain, returns are not. In fact, research shows that higher fees often yield lower returns, even pre-fees. And so in life, quite often, the more you pay, the more you get. However, with investing, the less you pay, the more you get typically. So fees are important things. So with respect to investing new money, investment approach, asset allocation, taxation, and fees, they're kind of the 4 key components that are all going to hopefully add value if you, work with an advisor. Now, the next element, apart from investing new money, is behavioural considerations. And I reckon this is probably the most valuable, although the most difficult, most valuable part of working with an advisor. At least that's what I've experienced or observed over the last couple of decades. But equally, it's very subjective, almost impossible to put a number on it in terms of value. But I think one of the biggest parts of my role is to stop clients making poor financial decisions. So counsel them in the way that avoids making any financial mistakes. And this is often referred to as behavioural finance. One of the advantages I have as an advisor is I don't have an emotional bias. I can really just focus on the financial aspects and see the wood from the trees and, really decide, okay, which is the best path here? Should we do nothing or should we do something? And doing nothing actually shouldn't be underestimated. Sometimes it's what didn't we invest in that's going to deliver value. And that can be hard to quantify, right? Because if I say, look, to someone, no, we shouldn't make that investment, 10 years later, we've forgotten about that conversation. But, the result of it could have been substantial. Often where there's stimulus, we think there should be some reaction. So often if something changes, people often feel inclined to want to make a responsive change. So if the market falls, if there's negative economic news, if there's new regulations, okay, what should we do about this? What are we going to change? Is quite often an approach or reaction that many clients will take. But in many situations, the best thing to do is do nothing. So it's really knowing when to act and when not to act. That can be really key. Overreacting can destroy a lot of wealth. And really successful investing is all about just making consistently smart, evidence-based financial decisions. Having the discipline to sort of ride out markets when they need to be ridden out, or to make changes when it's necessary to make changes. And quite often it's counterintuitive, these things. When you want to make a change, often the best thing is not change. And when you don't want to make a change, you don't want to sell out of a market because it's running hot. And quite often the best thing might be to actually reduce your exposure in that particular market. And it sort of goes counter to our sort of gut or emotional decision making at that particular time. And that's why working with a professional advisor can really add a lot of value. Although, as I said, it's very subjective. Unfortunately, as an analytical person, I like to be able to put numbers on things, but I've got to acknowledge something like behavioural finance is something very difficult to quantify in terms of value. The other advantage, the third one I want to talk about, is sharing the responsibility for making financial decisions, particularly if you have a family. One of the things that I've seen over the years that I really kind of discounted to some degree, and certainly years ago I did, but you can see it's a huge relief to some people. When they work with an advisor, they just think, okay, great. Now I don't have the sole responsibility for working this all out myself. And, I can then seek good quality professional counsel, and that's going to help me really make decisions. And ultimately, we're the ones steering the ship. So we'll be judged on the results, of course, but we've got to be able to influence decision making in order to add value. If I'm working with a client, they're not going to listen to my advice. What's the point? They're just wasting my time and their money. But, the reason clients engage me and our firm is to make better decisions. And so, of course, they've got to steer themselves or follow that advice. And it can be a huge weight off their shoulders in doing that. And then the fourth and final way I think advisors can add value is they're going to develop a long-term strategy, and then they're going to help you execute on that strategy. And let me use an analogy. A home builder's role is to go in and construct a house. So, they'll speak to the person that wants the home. The person says, build me a 3-bedroom home, and they'll just go and build the 3-bedroom home. An accountant and mortgage brokers, they act a little bit like home builders. They're just building to specification, if you like. In contrast, an architect will understand, what sort of house is going to suit you and your family and lifestyle. They will then develop the plans for that house and then liaise with the accountants and mortgage brokers to implement that plan. And in the financial world, a financial advisor is very much like the architect, if you like. And there's a lot of value in kind of bringing all those advisors and professionals together so that we're all working to the one vision and the one goal, which is obviously a plan that's been built specifically for you that's going to achieve what you want to achieve in that particular timeline. So just to highlight the four sort of areas there: how, when, and where to invest new capital, the behavioural sort of finance considerations, the sharing responsibility for making decisions, and the holistic advice approach. I think they're kind of the four categories, I guess, of where value could be seen, but, value is in the beholder, really. Now, it's important to talk about, how much does advice cost? And I find that, if you just go, well, all the research shows if you just go and ask a random number of Australians, you're going to get some, crazy answers, just a few $100s to, many thousands of dollars. Like, people find it difficult to really understand what advice costs. The most recent industry report says that advisors on average are charging clients $5,500 a year. And so let me talk to that figure because it's a high figure. It's higher than it has been over, it's increased significantly over the last, let's say, 4 years. And there's a reason behind that. Now, of course, that $5,500 is an average. There's going to be some clients with very simple needs that might be paying less than that. And of course, people with complex situations are going to be paying more than that. The reality is, over the last, say, 5 to 7 years, running a financial advisory business has become a lot more expensive, mostly due to compliance costs. And that these compliance costs can be sort of firm-wide or client specific. So the firm-wide ones can be things like paying for audits, compliance services, ongoing professional development, all those sorts of things. And then the additional sort of client-specific requirements are, things like preparing detailed statements of advice and records of advice and undertaking a lot of compliance stuff that's typically adds very little to actual value that the advice process provides. And our analysis highlights that just the compliance obligations alone cost us about $3,000 per annum per client. And that's before we really undertake 1 hour of work or any work really, of course. That's just kind of the overhead compliance cost. And there's two parties to blame for this. The first one is government. In fact, both sides of government have done nothing to improve the advice industry and only had a very ill-considered piecemeal response that has only resulted in half of the advisors leaving the industry over the last 5 years and adding a lot of cost and complexity to run an advisory business. And then ASIC, which is the regulator, they've also contributed to the cost. A recent example of a really poor decision by the government is at the moment, all advice practices are receiving a bill for something that's called the compensation scheme of last resort. The industry is paying $20 million into this scheme, and essentially the money is all going to go to ex-clients of a firm called Dixon Advisory. A lot has been written about Dixon Advisory. You can just Google it if you like, but essentially they were this rogue firm that were selling terrible, terrible investments to their clients. The regulator were tipped off many, many times by many, many people in the industry. They did absolutely nothing about it, and now the industry has to pick up the bill to compensate those clients. So put differently, all the rogue advisors have left the industry and the good ones are left picking up the bill. Now, I'm not sharing this example to seek sympathy, of course. No one's going to really feel sorry for financial advisors, of course, but it's just another example of government mismanagement because Treasury told the government, no, the government should be picking up the bill for this, not the industry. All Australia benefits from better regulation and the industry shouldn't be paying for it. But essentially, of course, you increase the cost to run a particular business, of course, it's going to flow through to pricing. So ultimately, it's the customers that end up paying more and financial advice starts to become more expensive, too expensive, and not accessible for the average Australian, which from a country perspective isn't good. And what we really want is if we can all build personal wealth and we can all prosper, then we're going to invest in things like education and all those sorts of things. It's going to produce a very prosperous country. And unfortunately, and I know I've got a vested interest in saying that, unfortunately, that's not the case. And as a result, advice now costs north of $5,000 a year on average. So what do you do if you have decided either you can't afford advice or you don't think it's in your best interest to get it? Well, of course, then you're going to have to take a DIY approach. And hopefully this podcast can help you with that. So if it's about superannuation, as you know, at the end of July or the start of August, I produce every year a review of the top 8 industry funds in terms of returns and fees and any other considerations. So hopefully you can use that sort of commentary and insight to make sure your super is well invested. And often super is a good way to access things like life and TPD insurance and those sorts of things. With respect to investing in property, I reckon working with a really skilled and reputable mortgage broker is very valuable because not only will they be able to help you with the loan, but they will typically have experience with working with buyer's agents, and a really good reputable mortgage broker shouldn't be taking any sort of kickbacks or commissions from those buyer's agents. So ask that question. But if they've got long-standing relationships with buyer's agents, that can help you narrow down who you should be dealing with. So from our perspective, for example, the buyer's agents we've been dealing with in our business, we've been dealing with them for almost 20 years. Now, we wouldn't continue to refer clients to them if the results weren't as what we were looking for. And so you can benefit from that experience, I guess. So I think property, work with a good buyers, a mortgage broker can help you steer in that direction. And then when it comes to shares, I've written blogs before about using diversified ETFs, but today more than any time in history, it's been they're really cost-effective ways to build a really diversified portfolio in share markets. So hopefully that DIY sort of approach together with this podcast can help you make some good quality decisions. Now, finally, just because a financial advisor tells you it's worth working together, that is, they see value, doesn't necessarily mean it is. You need to make your own assessment, right? And as I said, it's very subjective. Some people are going to see a lot of value, whereas other people won't see any value in working with an advisor. It is very much a personal assessment that should be undertaken kind of independently of, whoever the advisor you're speaking with. And similarly from our perspective as well, I know I can speak from our perspective, we don't want to work with someone unless we're absolutely convinced that we can add a lot more value than our fees will detract. We want to make sure that, if we work together over the next 10 years, that we'll look back over that period of time and go, it's a no-brainer. And of course, you're going to come across some advice firms that have different levels of clients they're after and those sorts of things. So you've got to take that into account as well. You might decide, yes, it's right for me, but then you've got to find the right firm that kind of matches your profile that's going to be good to work with. Anyway, that's a bit of a longer podcast today, podcast topic. We might have time maybe just for one question, but hopefully this analysis gives you, it's not perfect in terms of I can't tell you, look, if you've got this much and this much, then you should pay for advice. Unfortunately, it's not as clear cut as that, but hopefully the analysis and discussion gives you a little bit more food for thought. Okay, let's squeeze in one question before I let you go. And this question is from Jazz. Jazz writes, I'm a defence member, so he works for the Defence Force, with a defined benefit super scheme. I'm having issues finding information on the pros and cons of taking the benefit as a pension from 55 or a lump sum from age 60. Could you do a section of the show on defined benefit super schemes and general strategies for selecting pension versus lump sum? It's a good question, Jazz. I'm not going to probably do an episode on it because every defined benefit superannuation fund is different. So it's very difficult to talk about sort of general advice when thinking about these sorts of numbers. Most funds will be able to produce some projections for you. So that is, if you took a pension at 55, this is what the pension would be. If you took a lump sum at 60, this is what the lump sum would be. And then there's probably 5 considerations that I could think of that would help you then compare those two numbers. The first one is that if you did take the lump sum and assuming you earn, I would say 6 to 7%, I know that's low, but let's be conservative with the numbers. What you'd need to work out is how long would it take for you to run out of money? And you could just probably put that into ChatGPT. That'll work it out for you. I've got $2 million. Assume I earn 6.5% per annum and I'm spending whatever the pension amount is, because you want to compare apples with apples. How long would this money last? And ChatGPT will be able to work that out for you. And so if the lump sum is going to last you, let's say 50 years, we'll go with the lump sum because at least you're going to have something in your estate if you pass away and also additional capital. If the lump sum's only going to last you 10 years, then of course the pension's a better way to go. So that's the first consideration. The second consideration is what other assets do you have, if any? And so because one of the benefits of taking a pension is that you don't have any market risk. You'll get that index pension from the super scheme each year. Doesn't matter what the share market's doing, the amount's going to be indexed to CPI. Typically, that's how it works. I'm not saying it works like that in your situation. So you don't have any market risk. Whereas if you had a lot of other assets and it was beneficial to you, maybe you could accept to take that market risk. If you worked out the lump sum's actually better off, but you do have that risk that, you're going to have to invest the money. If you have a lot of other assets, then you can probably afford to take that risk. If you don't have any other assets, then I'm leaning towards taking a more conservative approach. The third element's going to be life expectancy, medical history, current health, all those sorts of things. Of course, the pension doesn't have any longevity risk. So if you're in excellent medical health and you don't have any adverse health conditions, then, you're not going to run out of money if you take the pension. Whereas if you've got a lot of health concerns, then a lump sum could work out better for your estate. Risk tolerance, of course, they're, happy to have, be open to sort of market conditions and so forth versus a pension that's not. And then beneficiaries, normally a super pension is what they call reversionary, which means a certain percentage will go to a surviving spouse if you have one, normally around 70% or something like that. And then when the spouse passes away, of course, the pension ceases. If you take the lump sum, however, that's all going to go into your estate. So I guess it's thinking about beneficiaries and any dependents that might be dependent on you. But the big one is really working out using a conservative return assumption, as I said, 6 to 7%, working out how long the lump sum will last you for. And then hopefully that gives you, a better sort of picture on which could work better. But of course, the other elements that I've spoken about are important to consider as well. Okay, I'm conscious of time. Just a reminder, I've got that checklist, that health checklist that includes 79 points on retirement planning, tax planning, all those sorts of things. It's available. You can download it for free. The link is in the show notes. So if that's of interest, check it out. Otherwise, until next week, bye for now.